Hello, I'm Randy Reiser, Medical Association of Atlanta President, and it's my pleasure to welcome you tonight to our program, Finance for Physicians, Covering Your Bases. This is the fourth in our series of presentations to our members that gives valuable information to our physician members and also to our patients. Our previous presentations have covered physician resilience, political advocacy, and information on COVID-19 vaccines. Tonight's presentation and all of our previous presentations are available online at our MAA YouTube channel, and we will have the information for that link at the conclusion of tonight's presentation. As always, I want to thank our program team under the leadership of Dr. Ali Rahimi for their excellent work in organizing and producing this series of programs. Tonight's program features a panel of experts in the fields of financial planning, wealth management, and insurance. And our moderator tonight is going to be Dr. Steve Walsh. I have had the pleasure of knowing Steve for virtually his entire career. He's a talented anesthesiologist, a great clinician, past chairman of the anesthesia department at North Fulton Hospital. And early on in his career, Steve realized what many doctors realize is that we don't know very much about finance. But unlike a lot of doctors, Steve decided to do something about it in a big way. And Steve obtained formal education in the field of financial planning. And about 15 years ago, he became a certified financial planner. So for a good part of his career, he's actually had two careers. One is a anesthesiologist, and the other is a certified financial planner. And in addition to all that, Steve has served as treasurer and president of both Medical Association of Atlanta and the Medical Association of Georgia, and he continues to serve in several key committee capacities in both of those organizations to this present day. So it's my pleasure to turn this program over to our moderator for tonight, Dr. Steve Walsh.
Well, Dr. Reiser, yes, thank you. Thank you for that introduction. And yes, it is my pleasure to have worked with the team putting this together. I think it will be a very informative webinar. And I'd really encourage everybody to take a little bit deeper look at the bios of our panelists. They're really very experienced and bring a lot to the table. I am going to go through a shorter introduction of our panelists in order to give more time for them to give us some information that we all can benefit from. So with that, I'll start off by introducing Hooman Omidpanah. He is with Lincoln Financial Advisors, and Hooman is going to kind of give us an introduction on aspects of estate planning and asset protection. Jose Cortes is a financial advisor and field director at Northwestern Mutual. And Jose will give us an introduction on, how to manage some of life's unplanned financial risks. David Hultstrom, a co-founder and chief investment officer of Financial Architects, will give us an introduction on kind of evaluating our accumulation and distribution phases of our retirement funds. Lastly, Benny Varzi with Merrill Lynch Wealth Management will give us an introduction of capital market performance and what it means to us today. So with that, Hooman, I believe you're first up.
Thank you very much. Appreciate it. So first of all, I want to thank the Medical Association of Atlanta for giving me the opportunity to speak with you today. And I want to thank all of you who are listening in today to learn more about financial planning. Today, I'm going to briefly touch on the process of financial planning and have a quick overview of retirement, estate, and as well as estate planning. Next slide, please. Thank you. So I know your time is valuable, right? And we have 4 presenters today, including myself, and a lot of material to cover. So I'm just going to go ahead and begin. To put our clientele in perspective, most of our clients have very competent advisors, such as attorneys, accountants, and other financial professionals, such as insurance agents or investment brokers, who have already helped provide them with a certain level of retirement, estate, or even investment planning. The question then becomes, if most clients already had competent advisors and have done some level of planning, then why would they have really engaged financial planning services? And the answer is simply coordination, right? More specifically, the lack of coordination in their existing planning, but really the desire to take that planning to the next level, right? What we do is go up in a helicopter, if you will, and we look at your entire financial picture at one time. We look at it from a cross-disciplinary basis, not just from a legal or accounting perspective, but across the board. And this allows us to identify both coordination gaps as well as financial planning opportunities. Next slide, please. In summary, people work with us because of 3 things. And so it's because of, and I call them the 3 C's, bring creative design ideas to the table in the areas of income, gift, estate tax reduction strategies, and also wealth creation. Many ideas which you may or may not have been previously exposed to. Secondly, to coordinate and to collaborate with your other advisors, such as your accountants and attorneys and other financial professionals. And third, probably my favorite, is to act as your catalyst to get things done. Our clients work with us because of our dynamic planning process, which involves really 3 steps. The first step, it really consists of comprehensive data gathering, where we carefully work with our clients to fully develop their ideal vision, their values, and their goals. The second step entails an analysis of their situation to see where their current arrangements are inconsistent with their objectives. And then third, obviously presenting the financial plan, reflecting all the objectives, that will help them toward achieving their goals. And finally, we begin the implementation phase. And here is where actually, the strategic financial plan is really put into action, and that each component is professionally coordinated and fully integrated. Next slide, please. So when we discuss financial concerns with our clients, issues usually fall into 4 key areas of financial planning, right? And those areas are financial independence and retirement planning, investment planning, estate planning, and business succession and business owner planning. I do have limited amount of time today, so I'm going to go ahead and briefly touch on financial independence and estate planning, although we do work in all these areas. Next slide, please. Most people are actively saving and investing today with the goal of eventually being able to independently support their expenses for life. This is what I like to call is the point of financial independence. And in my experience, I found that most people don't really plan on running their checking account down to 0 until they die, right? But in fact, to continue to grow their estates over a lifetime. However, understanding your particular time frame for financial independence will really dictate how you manage your resources and to provide for things such as, not like, college education or retirement planning, but also generational family wealth and charitable legacy as well. So the question is, do you have a feel for the track that you're on for financial independence? Are you saving enough, right? And do you know if those savings will be sufficient to meet your goals? Next slide, please. Some people are all set, right? They have it all covered, but many individuals really don't have a good feel for the track they are on for financial independence. And, upon review, many find that their resources aren't sufficient to support their objective. So people don't usually plan to fail, right? they fail to plan. And in the absence of planning, you may have potentially exposed your family to a number of contingencies, both pre and post-retirement. Some of those pre-retirement concerns include premature death, becoming disabled, accumulation and spending goals, and the post-retirement concerns include impact of inflation, becoming frail, healthcare costs, outliving your money. So failing to plan early enough may cause you to consider certain alternatives. One you may have to lower your objectives, which in this instance means reducing your standard of living, which may or may not be palatable. You may have to save more, which may or may not be feasible depending on your cash flow. You may have to increase the rate of return on your investments, which may or may not be prudent depending upon your tolerance for risk. Or you may have to postpone your retirement to a later date, which none of us wants to do, right? So one of the benefits of our work is that we help you quantify your particular situation through what we call economic modeling or financial modeling, which then allows us to make informed decisions regarding which adjustments, if any, should be made. Next slide, please. All right, switching gears for a moment, let's talk about estate planning. And what is estate planning? Estate planning is really the act of taking measures to direct the management of your belongings upon your death. It is also the undertaking to transfer wealth to surviving spouse, children, and other heirs in the most tax-efficient manner. But I want to touch on some of the facets of estate planning, right? Yeah, you can have wills and trusts and powers of attorneys and healthcare directives, great, right? But there's different layers here. And so estate planning is much more than estate tax planning. It spans distribution planning, asset protection planning, income tax planning, and so on. And each of these things are mutually exclusive. Asset protection planning is not dependent on the need to do estate tax planning, and income tax planning may outweigh estate tax planning, right? And so the art of estate planning really lies in successfully prioritizing and coordinating each of these areas. And orchestrating when and to whom the assets will flow is typically the foundation of a successful transfer planning. Fundamentally, it is important to analyze whether these transfers can be made during a lifetime, at death, or even in combination. Next slide, please. All right, so what you're looking at here is our family legacy pyramid, and planning distributions naturally begins with the client at the base of the pyramid, making sure you're okay. So strategies can have a cascading effect, right? Ensuring that the client is okay while also meeting the objectives of the family, right? Meeting the objectives of the business as well as the community. Most families we work with, excuse me, we have come to recognize that with wealth comes added responsibility. That at some level they have given up the right to simplicity, and then they have chosen to be good stewards and are interested in growing up the next generation of good citizens. And so there's really a desire to protect that wealth. Next slide, please. Asset protection is not merely to protect the wealth from those family members who might have a lapse in judgment or who might make less prudent investment decisions, but more importantly from everybody else. Protection against divorcing spouses, creditors, and frivolous lawsuits, while providing professional guidance and management leads us to leverage the use of trusts, right? And properly planned, these trusts can also be a tool for educating and preparing future generations, giving each generation a period of training wheels around the family's wealth and the legacy as well. Next slide, please. All right, so there are many estate planning techniques, and obviously we utilize so many different techniques to protect assets, but also to transfer assets to the next generation in the most tax efficient manner. But even simple strategies like even leveraging lifetime gift exclusions can still prove to be a sound economic strategy. In addition to all of this, surviving spouses have actually a unique opportunity to benefit from an asset protection of an irrevocable trust, right? A SLAT, or a spousal lifetime access trust, is really a good example of an irrevocable trust that is used for asset protection and generational planning. And it is used when the primary goal is to remove assets from your gross estate for estate tax purposes while maintaining direct access to income and principal for the spouse and children. And really the key word here with some of these trusts is flexibility. You want to make sure you have enough flexibility within the trust so that you can direct distributions to where you want them to go to. And if you don't have a spouse, obviously you can use this as a irrevocable trust, right? It doesn't have to be called a spousal lifetime access trust. A irrevocable trust works very, very similarly. So, just so you know, I mean, there's a significant wealth can be actually transferred in amounts much greater than what the current estate tax exemptions are, right? And creating asset protection for trust beneficiaries and really removing assets that are likely to continue outside of your taxable estate. So just a few closing comments here. If you do have estate documents, or I apologize, if you do not have estate documents, it's probably time to start thinking about them, right? But if you do have estate documents, make sure that you're reviewing them to ensuring that they're actually meeting your distribution objectives. Because at the end of the day, your assets will literally go to three places, right? One, is your loved ones. Two, your heirs. I apologize, your loved ones and heirs. Two, your desired charity. And three, the IRS. And I suggest you pick two. So next slide. Here's my contact information. I'm located in Atlanta, and my website is wealthplannow.com. If you have any questions, concerns, feel free to contact me via email or just give me a simple a phone call. Thank you again.
Yes, well, thank you. Thank you for that presentation, Hooman. I believe Jose is our next panelist. Thank you.
Yes, thanks, Steve, and thank you to the Medical Association of Atlanta for the invitation and for putting this together with such a diverse panel. So I'll spend the next few minutes talking about some fundamental planning pieces, really managing risk, preserving and protecting what we're building. I really like the chart that Hooman provided around financial independence with wealth accumulation arcing over to wealth distribution, because wealth accumulation is a lot more fun to talk about. And wealth distribution, how we're going to spend those dollars in retirement is a lot more fun to think about. But when we think about managing risk, is how do we protect and preserve the things that we're building for those that matter most. So next slide. And if you see a QR code at the bottom, there will be time at the end of the meeting for questions. But if you ever want to ask me anything directly, that QR code, you can literally put your phone up against the screen and it'll direct you directly to my contact form on my site, just in case we run short on time. So I'd love for you guys to take the next 30 seconds, and if you have a pen or a paper handy, just kind of take down some notes on, what are the things that you value most? What are your values that you stand for, that your family stands for, that your practice stands for? What are those goals or those priorities that you have set out for yourself, those most meaningful priorities, short-term or long-term? And what's the vision that you've cast for the impact that you want to have in the future? Because when we think about risk management or protecting and preserving what we're building, it's typically not a math equation or a financial number. It's about who we care about and what we care about. That's the next slide. And so if we think about managing risk with the things that we can't control, what happens if I become sick or hurt, if an event happens where I physically or mentally can't do the things that I'm doing today for work? What happens if I don't make it home tonight, if I pass away, or retirement? How are all three of these things the same? They're the exact same because, next slide, because your paychecks stop. And so first we're going to talk about the importance of your income. For the majority of young physicians just starting out and even established physicians as they're building out wealth, their most important asset is their ability to create income. Next slide. And why is that important? Because it's the integrity of the financial plan. The one thing that's going to fund and maintain our lifestyle, that's going to help us pay our bills, whether it's student loans or mortgages, whether it's going to provide for the most important things for us and for our family, our ability to preserve long-term financial security or maintain the practice value. If I'm forced to step away from my practice for a short amount of time or a prolonged amount of time, the impact that has to my employees and their families and the way that they provide and feed for their families. There's also the non-financial impacts, the emotional toll, or even the legacy that we might leave behind. Shannon, next slide. And so over 160 years, Northwestern Mutual has measured the main causes of disability claims. And now for the majority of the audience here, and I definitely thank you as well for being proactive and thinking about the importance of financial literacy, specifically for those in your space. But for most of our clients, they've all heard the story of the surgeon that goes on the ski trip, has a fall, an accident, breaks or fractures her hand, and they can no longer practice surgery like they practice today. But disabilities can come in all shapes, forms, and sizes. It could be something short-term like a car accident. It could be something like arthritis or losing vision, or it could be something more prolonged like an illness, like an MS. Next slide. And so the first component to understand is, how do you earn your income? And now, whether you're a PGY 1, 2, 3, 4, whether you're a DO or an MD, the way that you earn income will change over time. For some of our clients, their income is strictly salaried. For other clients, they may have income from procedures, from surgery. They may be under an RVU plan. They may also have non-patient care income, whether they're teaching or consulting, or expert witness. Next slide. But the important thing to understand is that you are different. The way that your income is created is a lot different than the average person that's clocking into a W-2 job and sitting at a computer desk. Oftentimes, a lot of our clients, they've got a salary from their main practice or the main hospital that they work at. They've got 1099s from multiple institutions or even in multiple states. And so, Shannon, if you'll go to the next slide. There are 4 key components when we think about protecting your income. And the first is to understand how your income is calculated, how your income looks on paper. What's the risk that you have that you're leaving on the table if you became sick or hurt and you were out for 6 months, for 12 months, for 2 years, or if it was for the rest of your life? The second component is the definition of disability. How does the insurance carrier consider you disabled? Which then ties into the third is, what's the strength of the contract language? Right? Oftentimes I'll have clients say, well, if I became sick or hurt and I couldn't practice surgery, maybe I'll go into teaching. Now, I don't think that I've been to a teaching hospital where the instructor wasn't also practicing. So that's a tough one. Also, I don't know if you guys want to raise your hands, but over the last 13 months, if any of us have had to become part-time teachers when our children went to digital learning. And I know what I learned was that teaching wasn't very fun, even for a third grader. My daughter's 8. And so, what we want to make sure we have is a good understanding of what the definition of disability is. How does it apply to us in our profession, and the options we have if the disability that we have still allows us to create some sort of income, but just not the way that we were earning it previously. And lastly is, what's the strength of the carrier? What's the strength of the company that's backing this promise? Because if you're in the worst situation that's just happening to you, to your family, to your loved ones, and to your employees, and you've got this uncertainty, who's backing that promise? So Shannon, next slide. 2 main problems I see is that our clients oftentimes, they feel like they're money targets. The misconception that we often think that healthcare providers are, whether we have deep pockets or it's just that sense of feeling that we're always getting called on. And the second, which is really today a tough one to manage, especially over this past year because of the great work that our healthcare providers have done, is scarcity of time. So do we have the right amount of time set aside to look under the hood and make sure these protections are in place? If they're in place, or do we have the right structure in place? So let's talk about life insurance for a minute. Next slide, Shane. And so, again, if we think about our values and our goals and who's important and what's important and the things that we're working towards, how do we make sure that we're protecting the possibility that something could happen that we're not here tomorrow? And so, next slide, Shane. On the personal front, typically my clients tell me they want to cover 4 things. They want to cover the mortgage, the house. If they're not here, their family's not getting kicked out. Second would be debts or final expenses, making sure nobody's left holding the bag. The third is typically a legacy piece, which could be college. It could be helping our parents in their financial situation. It could be the alumni associations that we're a part of or places of worship. And the fourth is replacing some sort of income for some amount of time. Now, if we've done our wills and we've gone through trust planning and we've measured the basic needs that we need for our family and the transfer of our assets, that could get very granular in the number. But I typically tell my clients, if you want to just simplify, just think about how much of your salary do you want to protect and for how long, and just not even taking into account inflation. If you needed, for example, $200,000 to last you for 25 years, maybe until your children are fully out of school, and your wife or husband reaches an age where they can take distribution from their retirement accounts without penalty, then as in this example, you would need $5 million of life insurance. Next slide. Now, let's talk about life insurance in the practice. So here's a good example of the work that our team did with one of our clients out of a pretty large specialty group. It's a multi-specialty group in Colorado. The firm was an upper out firm, meaning 2 or 3 years you either bought in or you left. And the cost to buy in was $100,000. It was paid $10,000 a year for 10 years. The buyout at age 65 was $500,000. It was $50,000 paid out over 10 years. And so our client, a medical oncologist, asked for the balance sheet. And she was offered shares after 2 years and came to us and wanted to make sure that she was looking at all the variables. And it was interesting, no new owner had ever asked for the financials. And so what we noticed was that all the buy-in money had been spent on operations, and there was no mention of the $500,000 future buyout obligation for each of the 257 shareholders. And these were financial statements that were being used for their financial growth, for financing buildings, for a lot of very important circumstances. And so, you know, the outcome was we ended up helping them structure with life insurance as an asset on the balance sheet, a way for both to fund the buyout, for it to be an asset of the practice, and to really protect against the loss of one of those shareholders. And so the ultimate outcome in this situation, the attorneys didn't catch it, the CPAs didn't catch it, and the practice eventually replaced those relationships, and eventually the CEO resigned. Next slide. And so let's talk about when life insurance is already in place in the practice. So our team helped a practice in Alabama. It was an anesthesiology group. There were 17 owners. Similar buy-in after 2 years, but this was with a reduced salary with some profit distributions. There was no buyout per se, but the owners did think about how to fund a buyout if a doctor passed away. So they went out and they bought $2 million worth of life insurance for all 17 providers from a not-so-proficient advisor, and the firm was the owner, the payer, and the beneficiary of the policies. And so what happened was each doctor named a beneficiary in their buyout, and then one of the shareholders passed away. And so the insurance company paid out $2 million, and the practice bought out the widow's shares. And at death, nobody reported it as a taxable event. So those designations and who's making the payment and who it's paying to is really important, but that wasn't even the worst part. Next slide. 5 years later, an anesthesiologist was sued for divorce, and her husband wanted 1/2 of the value of the 1/17 share of the practice. And what she and the group argued was no patients, no practice, no value. An anesthesiology group doesn't have repeating patients coming through the door on a regular basis. Their patients are usually referred by the practice that's providing the procedure or by the surgeon. And so they claimed there was no value there, but they had paid previously $2 million value 5 years earlier. And so the outcome, the judge said, you've got to pay up. You've got to pay up $1 million. And so inside of the practice, it's both having the right structure in place, but making sure that it's set up correctly. And next slide, Shannon. And so Hooman touched on this a little bit, but on the personal side, I can't stress how important designations are. Who's your beneficiary? Who's your contingent beneficiary? What happens if you're on a date night and you both pass away at the same time? Do you have any trusts set up in place for minors? Do you have any dollars that are going to a child or a family member with special needs that may be on Medicaid or Social Security disability? Or do you have blended families? I think Hooman touched on that, and that's becoming more and more important. And Shannon, last slide. And then inside the practice, most certainly inside of these documents, having language for death, disability, divorce, separation, and retirement. What's the valuation method? That's a big one that gets missed a lot, is what's the valuation method? When does that valuation date start, especially at passing? And if the doctor passed away in the beginning of the month and the value is on that date, or if it's at the end of the month, but the practice receives a large sum of life insurance proceeds and now it's sitting in the business account. Funding mechanisms, and then lastly, have spouses signed. And I think that I think this one gets missed a lot as well. Has the spouse reviewed and signed the partnership agreement, the buy-sell, or there's a practice at risk of them coming back and saying that it wasn't fair and equitable, especially if the past spouse or incapacitated spouse isn't there to facilitate that. So last slide, Shannon. So hopefully that was helpful. Again, a pleasure to be here. If I can answer any additional questions offline, please feel free to reach out. It's a pleasure to be a part and serve those who serve us. Back to you, Steve.
Yeah, hello, folks. I was dropped. I'm trying to get back in. Are you hearing me?
Yes.
Yeah. Okay, great. I'm sorry. Yeah. Well, I can see we're moving on. So, David, thank you for your being here tonight, and looking forward to your presentation. Thank you.
All right. Thanks, Steve. I'm David Hultstrom with Financial Architects. We named the firm Financial Architects. We think done properly, financial planning process sort of looks like what an architect does. Find out what the client's trying to build, and then after that, it's largely an engineering problem with some aesthetic stuff around the edges. And I'm going to do this a little differently than the other folks on the panel. They gave great information. Hooman and Jose did a lot, especially on the insurance, and had a lot of good slides. I have 2 substantive slides. This is not one of them. And I'm going to give you the 4 rules for guaranteed financial success. So if we go to the next slide. So the preliminaries here, and I'm going to spend most of my time on the 4th one. So this slide we're going to go through. First of all, we need to talk about what financial success is. And to me, financial success is simply having more than you need. And another way you might think of it is, the economists have studied this, and what maximizes happiness lifetime is to have levelized consumption. So do you have a financial plan in place that upon retirement or upon disability or death or something like that, the consumption of the household does not dramatically change? And again, some of my co-panelists have done a great job on pieces of that. So with that said, what is financial success? I'm going to talk about 4 rules for guaranteed financial success. And I'm sure my fellow panelists sort of raised an eyebrow when they saw the word guaranteed, because you're taught in this industry to never use that word because it makes the regulators start hyperventilating and the securities attorneys start salivating and so forth. So, but I think it really is. I'm going to give you 4 rules, and they're pretty extreme because this gets you to guaranteed. So I'm not saying that if you don't follow these 4 rules, you're destined to a life sleeping out of doors. But if you follow these 4 rules, I don't think you can mess it up. So with that said, let's go ahead and go forward. So here's the first one. Start young. So if you're not young now, you can't do that one. So I'm already off the hook on the guarantee for you. So let's go to number 2. Hedge all the risks that you can. And again, my fellow panelists have done a great job on this, particularly the life, health, disability insurance. Also, we don't sell any insurance. We're fee-only financial advisors. We do financial plans, standalone. We charge for those. And then we do wealth management. And then forward, we refer out estate planning, although we review all the documents, but we're not estate planning attorneys. We review tax returns for clients every year, but we refer that out. We review all the life insurance and disability insurance and property casualty and all that stuff, but we don't have any of those licenses. We refer all that out also. So you want to hedge all the risks you can. So in addition to sort of things that have been mentioned with life, health, disability, divorce is a risk. Also avoid concentrated positions. Sometimes people are overly concentrated in something, and that's a risk to becoming financially successful. Let me give you a very quick example of a CPA who was unintentionally concentrated. And as far as I know, it didn't blow up, but he and I talked years ago, and he didn't realize he was concentrated. This is a CPA who lived in the west end of Richmond, Virginia. You probably don't know Richmond. The west end of Richmond, Virginia is dominated by a Capital One facility. So a huge number of people in that end of town live, work for Capital One. So CPA had a practice. He bought his own office building. His practice was the tenant. His wife worked part-time in the practice and not anywhere else. They had a house in that end of town, and most of his clients were Capital One employees. And I was talking to him, and he said he was diversifying by buying rental properties. I said, well, that's great. Where are these rental properties? He said, right here. And so he unintentionally is enormously exposed to Capital One, even though I'm sure he never thought of that. If Capital One goes down, his office building is worth less, his practice is worth less, not worthless, but worth less. The rental properties would be worth less, and he would be impacted. So make sure you think about diversification and hedging your risks and so forth. Also in your portfolio, not only avoid concentrated stock positions, obviously don't put all your money in Bitcoin, but also don't put it all in any one blue chip stock, and diversify between stocks and bonds, between domestic, international, and so forth. So that's probably enough on that. So let me move on to the sort of the next thing. Third rule is never borrow money for a depreciating asset. Now, again, I said at the beginning, you're not doomed to failure if you borrowed some money to buy a car one time. But if this is the guaranteed rule to make sure that people, if they follow these, can never fail, don't ever borrow money for a depreciating asset. Now, people who are less sophisticated in this audience frequently ask me, well, I don't know what that means. What's a depreciating asset? And the easiest way I found to explain it is there's only 3 things I think you can borrow money for, and all the rest you should not do. The only things that are not depreciating that I would borrow money for is, number 1, prudent education. Now, obviously, it would be great if everybody could go to school and not have any student loans. That's not always possible. But if it's not possible, you've got to get a reasonable degree at a reasonable cost. In other words, if you go to a very, very expensive school and major in English and take out student loans to do so, that is unlikely to work out well. We met a young lady a couple of years ago who had north of $300,000 in student loans to get her chiropractic degree. That is unlikely to end well. You're just not going to have a high enough income to pull that off. The second appreciating asset, second exception to the never borrow money for depreciating asset, would be a primary residence. Obviously, most people don't have cash to put down a primary residence, but you want to keep that at a reasonable level. So my personal rule for primary residences, again, this is a little conservative, is you should never pay 2 times your gross annual income for your house. If your house is worth more than 2 times your gross annual income, it's probably more house than you need. Obviously, if you're in San Francisco or New York City or something, you'd have to stretch that a little bit, but that's good. So that's all sort of preliminary. I'm sorry, I left off the third one. The third exception to the depreciating asset is for low risk investments. For example, if you have a business you need to expand, or you have a line of credit for working capital, or you're buying a rental property that's low risk, those would all be reasonable places to borrow some money to lever that up a little bit. But other than that, I think you should not borrow money for a depreciating asset. All right, that brings us to the fourth one, which is sort of the main topic here, the big rule. And that is have appropriate savings and spending. And I'm gonna preach a little bit here at you guys. I know that most of you on this call are probably doing fine. We work with some doctors in our practice. We don't intend to have a very large practice, and we have some doctors, but we have probably turned away more doctors than we've accepted, because even though the incomes are high, the wealth in proportion to those incomes is frequently not. Because a lot of doctors, again, not everybody, but a sizable minority, don't have appropriate savings and spending levels, in my opinion. So for example, recently we had a doctor we did a financial plan for. In our financial planning process, we do a financial plan for folks as a standalone thing that we charge for. And then after that, if we invite them to become a wealth management client, we'll work with them going forward over time, of course, if they want to do that. And this doctor, we did the financial plan. We did not invite them to become a wealth management client because the doctor had $3 million in a portfolio and 401ks, et cetera, total. They had two houses, neither of which had mortgages. One was $1 million-ish, the other was $1.5 million-ish. That all sounds fine. He was in his early 60s. Problem is, needed $400,000 a year to live on. And that was a drop dead number. Can't go under that. Has to be 400. And retiring next year. And I can't move that. And we said, well, you could sell one of the houses. Nope, can't sell either house. Wife likes one, husband likes the other one. They have to keep both of them. You could work longer. He said no on that. You could reduce your lifestyle. Said no on that. So this was the first financial plan that we have ever run that had a single-digit success percentage at age 100. We usually run out to age 100 to be conservative. And sometimes you get some that are not as high as you'd like, and you have to tweak things. So not only was it single digits, they really didn't want to change anything. So that's a problem. So how do you avoid that? How do you have appropriate savings and spending? The first thing is, I'm going to give you sort of the normal version of this that I give to most people, and then I'll add on for higher income folks, because virtually everybody on this call, I'm sure, is higher income. For moderate income folks, I tell them just maximize all the tax advantaged plans you have available. So that would be 401ks, 403bs, IRAs, Roths, all those things. If you maximize those, assuming you have them available to you, you're usually saving a decent amount of money. So my daughter is a senior in college. She's headed on to Duke Medical School, actually, for a DPT degree. I told her, feel free to marry a doctor. That would be very good financial planning. But I've told her, when you get out and you get into the workforce, you've got to maximize your 401k. Dad may help you if you just can't get that done, but you've got to maximize the 401k. And I've always maximized her Roth every year. Every time she has earned income, we max out the Roth. That's just sort of in our family, that's a fundamental baseline rule, to maximize all. I don't mean up to the match, I mean to the max. And then in retirement, never take more than the required minimum distributions out of those plans, right? So if you do those two things, you're saving at a pretty healthy rate, and you're not spending at a high rate in retirement. And remember, there was no debt, no consumer debt, so you're largely fine. That's where I get to the guarantee. Now, for high income folks, the tax advantage plans may not be enough saving. And so I did some research years ago using sort of a simple model, reasonable rates of return and sort of typical lengths of work versus retirement and so forth. And I tried to solve for how much, if you want level lifetime consumption in real dollars, how much do you have to save every year so that when it flips over from saving to spending, your lifestyle is sort of level? So in other words, if you save 10% of your income, that means you're spending 90%. Would that build up to be enough that in retirement, you still have that 90% sort of spend level? And the answer I came up to was right at 25%. And that sort of freaks people out a lot. Now, there's two things you can include in that make it a little bit better. One is the Social Security, not the Medicare part, but the Social Security part, I think counts as savings. It's certainly the employee half, I'll let that count. All in with the employer half, that may be counting too much because it's not a great return on that stuff. The second thing that you can count toward that 25% is principal payments, or the portion of your payments that are principal on mortgages and things like that. So that is savings. That's an increase to your net worth. It really is 25%. I know people think it's not 25%. I know people think I couldn't possibly save 25%. And I have an answer for those people who think they could not possibly save 25%. There are people all over the place, especially all over the world, who live on 75% of what we make. Everybody in this call, I'm confident there's people who live on 75% of what you make every year. And they're not sleeping out of doors, right? Your savings rate, and I stole this from Morgan Housel. He has a great book called The Psychology of Money. I highly recommend it. He says your savings rate is just your difference between your income and your ego. Let's go preach a little bit. The 25% savings rate. And then when you flip over to retirement, there's been a ton of research, literally hundreds of papers on sustainable withdrawal rates. I've reproduced the research myself just to make sure I agreed with it. I do agree with it. For normal length retirements, reasonably aggressive, but not entirely aggressive portfolios. In other words, anywhere from say 50-50 stocks bonds up to 90-10 stocks bonds, 30 years of retirement. If you want level lifetime spending out of the portfolio, it's roughly a 4% withdrawal rate will do that. Under that, it gets really, really successful really fast. Over that, you're in danger of running out of money. So that means if you need $100,000 off of the portfolio to live on in retirement, so out of the portfolio, you could have additional money from Social Security and other things. $100,000, you need a $2.5 million portfolio. If you need $200,000 out of the portfolio, that's $5 million. That's sort of a rough, it's Monte Carlo simulation is the math you use to do this. I wrote the simulator that we use in Excel, but you can, if you don't have unusual cash flows and things, you can sort of get a rough estimate using what's called the 4% rule. So those are the rules. I hope I haven't freaked people completely out, but that's how you get to financial success, I think, guaranteed. So I'll turn it back over to Steve. There's my contact information.
All right. Great. Well, thank you, David. Yeah. And we come to our last panelist, and that's Benny. And Benny, we look forward to what you have to say.
Thank you, Dr. Walsh, to put me right before dinner. I appreciate it. It's great to be here, guys. As Dr. Walsh said, my name is Benny Varzi, and I'm a senior partner and the portfolio manager of the Varzi Group of Merrill Lynch, Bank of America. It's great to work with physicians. I got to tell you, 40 years in the business, I've worked with a lot of physicians, but the most successful physicians didn't make their money off of their practices. They made it because they were good businessmen. An example of it was a radiologist, a friend of mine, who started as a radiologist, but then started buying all their own MRIs and all the buildings that went around those MRIs. And then after a few years, the real estate arm of their business was worth substantially more than the MRIP. So I sincerely enjoyed the presentation of my four colleagues and agree 100% that the most important pillar of success in achieving your financial goal is a solid financial plan. And financial plans are not ever once and done document. The plan is a vibrant and live document that should be visited often and tweaked based on changes in objectives, risk tolerance, performance, longevity, on and on and on. The results and success of a financial plan depends on several things. First two is very obvious. How much money do you have today to invest, and how much money do you have to add to your investments over the years? The third one, though, very few people pay attention to, is that how disciplined are you to stick with a financial plan and an investment strategy during thick and thins of the market? One of the most critical components of a financial plan is not to get rattled and scared when the markets are down, and not get overly excited when the markets are up, like right now. Because doing so will make you sell and get out of the market when the market's in lows, and buy at the highs of the market. And the easiest way going broke, trust me on this, is to consistently buying high and selling low. Now, this is a lot easier to talk about than actually doing it. You see, back in March of 2000, when the pandemic was just starting, how many of you actually sold some or all of your investments and got, because of fear of COVID, and got out when you should have absolutely done the opposite? This was also true in March of 2009. See, I work for Bank of America, Merrill Lynch. Think about it. The stock of Bank of America back in 2009 got as low as $1 a share. Today is at $40 a share. This is the only business I know that when things go on sale, nobody wants it. But when things are priced at the highest level they are, everybody wants it. Imagine if you're looking for a pair of Nike sneakers and they're about $200 a pair. First of all, that's crazy. Only my kids, my daughters buy it. But if they go on sale and now they're selling at $50 a pair, you probably go out there and buy 4 of them. But if they all of a sudden go to $400 a pair, you probably just tell yourself, no way, who pays $400 for a pair of sneakers? Well, why wouldn't you apply the same logic to investments in capital markets? I think the reason is that investors mostly confuse risk with volatility. You see, risk is when you invest in an investment such as individual stock or a leveraged real estate or a business that investment simply goes out of business and its value goes to zero and you have no way of recuperating your investment. Volatility, on the other hand, is if you invest in a diversified portfolio of assets, be it stocks, real estate, bonds, businesses, on and on and on, and see the value of these investments go down due to some external factors, such as COVID-19 or trade war with China or political election last November. How many of you all got rattled because of that? Because you see, volatility is always temporary and almost always will swing the other way around. So if you understand the difference between risk and volatility, first of all, you will organize your portfolio that you don't take any undue risk by overweighing in any one particular risk asset. And 2, you would welcome volatility, as you know that it's temporary and it's giving you a chance to buy that sneaker at a fraction of its cost. This is especially true for you physicians or investors when you're in your accumulation phase and not distribution phase. I personally, for me, not for my clients, but for me, would rather the stock market to stay down for the next 20 years so that I can invest and keep putting money in it every year and then go up when I start actually spending this money. Now, the 4th thing that determines the success of the outcome of your financial plan is what percentage will you earn on your investment. You see, the power of compounding interest is unbelievable. Albert Einstein famously said that compound interest is the most powerful force in the universe. He said compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. You see, the difference between earning 4% on your money or 6% on your money, compounding that difference for 30 years, and I know I'm going to make a lot of my Mississippi clients upset, but would be the difference between retiring in Tupelo, Mississippi or Hawaii. And of course, I, for one, would prefer to retire in Hawaii and play golf and go hiking and everything else. So you have to understand that for every level of return, there is a level of volatility or standard deviation. So if you don't want to have any volatility in your portfolio, then you can only expect the risk-free return of treasury bills, which is 0. And if you want the 8%, historical 8 or 10% of the stock market returns or real estate or other businesses, then you have to live with that standard deviation of 10%, 15%, 20% volatility of that particular market. So now to help you achieve the higher returns, let me tell you very quickly our thoughts on the markets and the economy, and then we'll open it up to question. I guess the best way for me to title my thought, and by the way, I'm utilizing a lot of my unbelievable research folks at Bank of America, Merrill Lynch on this, but the best way to title my thoughts would be to fasten your seatbelt. The evidence keeps pouring in to support our view of strong economic growth this year. We have therefore become even more convinced and are revising our forecast higher to 7% GDP growth this year and 5% next year. We now expect an even a greater acceleration in growth mid-year with it carrying over to 2022. If you're not convinced that the economy is as hot as it is, try to book a flight or a hotel room for this summer. We just came back from New York City and it was impossible to get a restaurant reservation in any of the city's top restaurants. LaGuardia Airport was as busy as I've ever seen it, and the security line at Atlanta Airport was all the way to the middle of the atrium like the old days. If you still don't believe me, try to go out there and buy a car. There is no car in any showroom, and used cars are trading at 20 to 30% higher than they were before. There are three critical reasons for this optimism and what's happening. One is momentum is building for a very large fiscal stimulus package. We just received $1.9 trillion. President Biden is going to talk about another $1.6 trillion tonight. There's another talk of about $2 to $4 trillion of infrastructure spending. The second reason is we're getting great news on COVID. 50% of Americans have already received at least one dose, with over 1 billion doses have been administered worldwide. And the third reason is we're getting great news and strong data. With our new forecast, growth this year will be the strongest in nearly 4 decades, in 40 years. And we believe this will go down in history as a rubber band cycle. The bigger the decline, the faster the snapbacks. This recovery could not be more different than the one following the global financial crisis. That recovery was plagued by household balance sheet repair and insufficient fiscal stimulus. The opposite is in play today, with a squeaky clean household balance sheet and aggressive fiscal stimulus. Households in America have the highest savings rate in modern history, and they're sitting on about $2 trillion in checking and savings account, waiting for what I love to call revenge spending. So our forecast allows the economy to return to a pre-COVID level of GDP by second quarter of this year. And although we think that there's a meaningful probability that the infrastructure bill in the range of $2 to $4 trillion will be passed later this year or early next year, there's too much uncertainty on its composition and timing to confidently incorporate into our forecast for the moment. Passage of the infrastructure bill will clearly be a tailwind for the economy even more, starting sometime in 2022 and beyond. The news on the virus fronts has been extremely positive, and even though there's concerns over the rise in cases maybe in the fall, but we think that the high level of immunity, success of vaccination would mean that the demand for leisure and COVID-sensitive services spendings will be unleashed even earlier. Adding fuel to that, this will likely coincide with the distribution of another round of spending. So we think that the consumer will be able to deploy some of their excess savings and re-engage in the economy. The other thing that's happening, earnings are coming out great. Just tonight, we had earnings announcement from Apple, from Facebook, from Qualcomm, and of course, yesterday we had announcements from Google, and every one of these companies reported earnings that were substantially better than expected. I mean, in the case of, I think, Facebook, their earnings was up 48%. And so earnings are going phenomenal. We have raised our estimates that again, first quarter by another 6% over the past 3 months. And we now expect the S&P 500 to earn almost $42 a share in earnings. However, just to tell you that we are at the highs, blowout quarter in earnings doesn't necessarily mean blowout markets. Investors were very unenthused by a big beat last quarter. I mean, perfect example, and even this quarter, a perfect example was yesterday when Microsoft reported great earnings on every front, and the stock went down nearly 3%. So a lot of this good earnings and good news is already priced into the market, and you need to be aware of that. Finally, I'd like to share a few slides. I know the slides have been going up and down, but the first one I want to show you, if you go to the next slide, is about interest rates. Believe it or not, Merrill Lynch has done research and looked at interest rates for the past 5,000 years. And this is the lowest interest rates we've had in the past 5,000 years. Now, this has a lot of consequences, right? The biggest consequence is that if you're borrowing for whatever it is you're borrowing, if you're borrowing to build a business, buying a home, go ahead and borrow it, get the money, lock it in for as long as you can. The other consequence is that if you're a saver, if you want to put your money in some fixed income investment, be careful not to put it in very long-term investments. This year actually has been the worst year performance-wise for long-term bonds, probably in history. I personally can't remember in the past 40 years a worse quarter for bonds than I saw this first quarter of 2000. The second slide, which again, I want to show you because I want you, again, look at the, buying high, selling low. Look at the stock market since April of 2020. What is gone? I mean, it's gone parabolic, right? It's gone straight up. Now, nobody says cannot go higher, But you just gotta have to understand that the markets have gone up a lot in the past year alone. So therefore, if you are an investor, have some dry powder, be patient, you will get an opportunity to put it back to work. The latest wave of market enthusiasm has brought with it a stunning rush of money in which more investors' cash has gone to stock-based mutual funds in the last 5 months than the previous 12 years combined. Think about that. More money has gone into the market in the past 5 months than in the past 12 years. This statistic from Bank of America reflects a period in which the Dow Jones Industrial Average has risen probably close to 30%. Amid this frenzy, almost 600 billion, 560 billion has gone into global equity funds since November, compared to 452 billion the previous 12 years. That goes back to the beginning of the longest bull market run in history. These numbers can easily exacerbate ongoing worries about financial market bubbles, as valuations are around the same levels as just before the dot-com bubble. But of course, there's a little caveat to that, and I'll talk to you about it in just a minute. The third slide shows you why the economy is doing what it's doing. The Federal Reserve balance sheet is at the highest level since 1914. And the US budget deficit as a percentage of GDP is at the highest level since World War II. The fourth one, a slide that I want to go through very quickly, is our theme for 2020 versus 2010. 2020 was about the 1%ers, right? Now this 2020 is going to be the other 99%. 2010s was about Wall Street. 2020 is going to be about Main Street. 2010 was about maximizing wealth. 2020 was about maximizing health. And then deregulation versus intervention, globalization versus unionization, corporate buyouts versus health taxations. We have inequity versus inclusion, and on and on. We have large cap companies that did very well in 2010s. Now we expect small cap. US did very well 2020. We expect international stocks to do well because they're much less valued. US dollar was the focal point in 2010. This year we're talking about cryptocurrency, and I think that's going to be here for a while. Last year was about selling volatility. This year is about buying volatility. And then finally, deflation was the word in 2010. This 2020, we have to worry about inflation, which has very profound effect on anything you do in your life, I promise you. And then finally, if you go to the last, I think the last slide, this shows you, again, the technology as a share of global equity market. We are now over where we were in 1999 during the dot-com bubble. But of course, the reason for that is that you got to be aware is that everything is technology now. For example, car rental company, try to rent a car. Now I understand that there's an Uber for car rental, that people actually rent their own cars using an Uber type app, which tells you that now car rental companies are technology companies. And I think the final chart shows you that, again, the valuation. So the S&P 500 trailing 12 price earning ratio is about 28, which is right up there with July of 1999. Of course, the caveat is that this is because we had COVID and earnings went down to zero almost. So this is really not as accurate. But even if you look at the forward-looking earnings PE ratio in the market, we are about 22 times. It's not ridiculous. We're about 21 times. It's not ridiculously expensive, but it's not cheap either. So again, be careful out there. Invest for a long run. Don't get rattled with markets going down, markets going up. Take advantage of the volatilities. Sell high and buy low. Okay. I mean, the famous words. So with that said, we'll put it up to questions, and thank you for having me.
Yes, well, thank you, Benny, and all the panelists for the great information we've heard tonight. And yes, we now move on to our Q&A part of the program. And I'm going to start out maybe with our last panelist and move back to our first panelist with questions. So the first question we have here for Benny is related to bonds. Benny, you had mentioned, back in the 80s when you were newer to the industry, we had 15% bonds, and now we're at the other end of the spectrum. So recognizing that bonds are a component of a portfolio, what approach are you recommending at this point in time?
Well, there are several things you can do. One, of course, the safest, and when I look at some of the institutional money, the safest is simply sit in short-term bonds or cash and wait it out. That's the safest. But if you can't do that, then the second way of doing this is what they call laddered investment, which means that you take your money that you want to put in bonds and divide it up between 10 or 15 tranches and invest in different maturity. So you go 1 year, 2 year, 3 year, 4 year, 5 year, 6 year. That way, if the interest rates continue to go down, at least part of your money is locked in at a higher rate. But if interest rates go up, then part of your money actually comes in today so that you can lock in at a higher rate later on. The other way you can also protect yourself is what they call, and I don't want to get too technical here, is to invest in what they call cushion bonds, which means you buy a higher coupon bonds at a premium with a shorter call date. That way you get more of your money today because the interest that you're getting is higher. Okay, you get more of it today, and then you lose some of that in the principal when that bond matures. And then the other thing you can do is to diversify your bond, just the same way that you diversify your equity portfolio before different sectors. Diversify your bond portfolios amongst different kinds of bonds. Mortgage-backed securities, municipal bonds, corporate bonds, treasury bonds. Emerging market bonds. There are so many different bonds with different characteristics that move at different times. So again, diversification, be patient, don't be aggressive on bonds. Interest rates are at all-time low. The odds are we're going to have some higher interest rates down the road. And if you own long-term bonds, you can really, really get hurt if interest rates move up. So just be patient.
Well, thank you, Benny. Well, David, I have a question here for you, and that is, what I heard in your presentation, for a lot of people, saving is difficult. So when you look at your successful clients, how have they become successful, and how have you helped them become successful with that saving portion of that financial plan?
Yeah, so it's interesting. I'm not sure I can make people successful. In our financial plans, which we don't have canned software, we actually custom write them for each client. But there's a template, obviously, that we've developed over the years. And part of that template says, we think we have limited ability in the area of behavior modification. We assume our clients' challenges are primarily technical or educational or whatnot. So I'm not one that really thinks I can move the needle on that. However, I did just recently write a paper on the two things that I think cause people to tend to be pretty significant savers. And the first thing is that they have a long time horizon. And the financial way of saying that is they have a low discount rate. Somebody who has a 30% discount rate will think that 18% credit card debt is a screaming deal. Somebody who has a 2% discount rate thinks that paying down their mortgage is a screaming deal, right? So that's the first thing. And then the second thing is a psychology thing. It's locus of control, which I don't know if people are familiar with that, but an internal locus of control means that you think you can affect things. An external locus of control means you think things happen to you. If you have an external locus of control, you're unlikely to save because you think, well, if I save some money, I'll just lose it, or something will happen, or I've got, relatives who will think that I should give it to them if I accumulate a little bit. But you can also have too high of an internal locus of control. For example, there are people who think that because they picked the stock that it's going to go up, right? They think that they have the ability to market time or stock pick, or that they're going to win the lottery someday or something like that. That's a locus of control that's too high. But people who have an appropriate locus of control really are well calibrated, is the term in the literature, on what they can affect and what they cannot affect, and who have long time horizons tend to be pretty good savers. But I'm not optimistic about my ability to move somebody on those two needles.
Well, thank you, David. That's very interesting. Yeah. Well, I have a question here for Jose that's just come in, and yeah, Jose, I have the question here has to do with universal life policy. If somebody has some cash value in a universal life policy, what considerations might they make when they're trying to decide if they should take some of those funds for some home improvement versus maybe getting a equity loan for that home improvement? What might be the considerations in that scenario?
Yeah, absolutely. Well, the first thing to understand is that the benefits of having capital tied up in a life insurance policy is that it grows tax deferred, and you've got some unique ways which you can access that capital. One of those is a policy loan. So I think in this situation, regardless whether it's home repairs or another financial objective, it's what's the net cost to borrow? What's the cost of the policy loan? What is how is that loaned out amount recognized? And then what are your other options, right? If you have that cash position, are you clear of the fully funded emergency fund? Are you relying on any of that cash? Is that maybe a more efficient use? As Benny mentioned, there's not a lot of good options for safe money. That line of credit, are there other options for that line of credit? Maybe you can take that universal life policy and you can collaterally assign the values, and you can get a line of credit using the values of the policy at a lower interest rate than 3.7. So some of our clients can get prime minus 70 basis points if they're above $100,000 of cash value, and then if they've got that line of credit tied to the business, depending if it's home renovation may not be a business objective, but if it was in the business, it might be even a tax deductible interest rate. So a couple of extra questions I would ask, but I would say maybe start with what's the net cost to borrow. But a universal life policy can certainly give you some flexibility.
Well, thank you, Jose, for that question. Yeah, that answer. We have another participant with a question here, and for Hooman. Hooman, you mentioned in your presentation an aspect of asset protection. And, for physicians, one of the things that we are seeing now is higher and higher judgments in the med-mal area, to the point that there is concern whether that judgment will exceed the level of insurance that a physician might have. So, are there some revocable trust mechanisms that might be available with regards to asset protection in that scenario?
Can you hear me okay?
Yes.
Yes. Yeah, with revocable trust, typically it's kind of fair game, because everything it's in a irrevocable trust is kind of like in your taxable estate, right? And so you can have some sort of a asset protection level tied to those, but honestly, having typically what we see to get a business or practice, for example, to have a fully asset protected, we tend to put those into some sort of EREF trust. And so the way that they're set up is, for example, they can put them into some sort of a intentionally defective trust, for example, right? Or so there's different types of trusts that are out there. Irrevocable trusts are not as asset protected as irrevocable trusts. So, but if you have any more examples, I can definitely look into it for you, and for sure come back to you with some more findings.
All right. Well, thank you, Hooman.
Yeah.
Yeah.
I also saw a question came in from an estate tax perspective on estate exemption amounts. I think it was on the actual estate taxes. And so I just wanted to address that real quickly. The current exemption that was for estate taxes are about $11.7 million, right? And that is a exemption that was passed into law by President Trump back in 2017. So for the first $11.7 million that's inside of your taxable estate, you're not going to get hit really with a federal income tax, right? So that is coupled for if you have a spouse, your total exemption together will be $23.4 million for this year, for 2021. And that is up actually slightly from last year, because last year, it goes up on an annual basis based on inflation. Now, anything over that $11.7 million is going to get taxed at a max tax rate of 40%. And there's a gradual tax that goes up, and I think it starts around 18%, it goes up to 40%. But anything over that amount, it gets taxed at 40%. Now, in 2026, I believe in January 2026, those values would drop. The state exemptions will drop to half of the current amount. And so there could be a state tax problem for somebody that has, for example, more than $5 million in their taxable estate. And that's based on the Tax Jobs and Cuts Act. Now, President Biden has a proposal out right now that could really reduce some of those exemptions as well. So because it's not into law, I don't want to really talk about the actual numbers, but those could come down. And then if you have substantial assets inside of your taxable estate, those could be definitely you might have an issue. You might have a estate tax issue. So definitely things to look out for.
Well, thank you, Hooman. Well, we have another question here for Jose. We're working back the other way. Jose, in our medical practices, sometimes we have an option with group disability. So what are the things someone might consider in terms of how to balance that group disability coverage with individual policies that they may have, pros and cons and considerations? Yeah, Jose, am I connected still? I believe I've lost my audio.
No, you haven't, Steve. We can hear you. Jose is the one that I don't think can hear us.
Jose's can't hear us.
Okay. Well, maybe, David, are you able to send Jose a text maybe so he could maybe try to see how to get back his audio? But with that, I'll move on to David at the moment. David, I know that you've done a lot of study in portfolio analysis, and one of the things we even have in our MAA endowment is a combination of kind of a passive investments as well as active. In some of your studies over the long term, what do you find one of the biggest determinants are in terms of performance in those two areas?
Well, I think across all investments, regardless of whether it's active or passive, it's actually the same thing. The evidence is overwhelming that low costs are the primary thing. And so I try to be really careful not to say that active management doesn't add value. It very well may. The problem is I have no way to identify the active manager that adds value in advance. You never have enough data. So I did some research a while back and assumed that a manager had 2% alpha. So they outperformed their appropriately specified benchmark by 2% a year, which, as my fellow panelists know, is huge. People would kill their grandmother for a 2% alpha. And assuming that you're 90% correlated to the benchmark, which is sort of normal, and assuming 20% standard deviation, which is sort of normal for stocks back to 26, the question is, how many years of data would you need to know with 95% confidence, statistical significance, that the manager was better, not 2% better, just not worse. And the answer is actually 76 years. And we never have 76-year track records. So that's the problem. The only sort of modern ones that I have found that were statistically significant outperformance, Warren Buffett had done it. I haven't checked that lately. He's been flat for a while, so maybe he's dropped below, although I suspect not. I suspect he's still good. And the other one was Bill Miller, the year right before he blew up. He hit statistical significance and then, of course, crashed and burned. So, again, people like buying active management. It feels like, well, somebody should be able to pick. I have a lot of designations, including a chartered financial analyst and so forth. And the more I study, the more I research, the more I think that you're better to buy the entire asset class, diversify the asset classes, certainly, maybe tilt some value factors, some factors like value, momentum, things like that, but not try to do individual security selection or to market time very much at all. But that's a minority opinion in the industry. People want to do, and I feel like I've been picking on doctors a lot, and I really don't mean to, but especially a lot of doctors, they want to do the active sort of sexy thing. And again, a lot of doctors do great. We have clients who are fantastic, but sometimes they're attracted to sort of the niche investments because they're cool. And it seems to me like sometimes people, not only doctors, but other people also are more interested in something fun to talk about at parties than actually making some money. So.
Well, thank you. Yeah. Is Jose back online yet?
I think so. Can you hear me?
Oh, great. Yeah, Jose. Yeah, we're glad to have your audio back intact there. Thank you. Yeah, we had a question for you, and it has to do with disability. You know, some medical practices will oftentimes offer a group disability, and you know, should you rely totally on that option, or do you want to have some individual disability, and how might you balance those two options, pros and cons?
Yeah, absolutely. Great question. So group disability is a good to have, but here's what you're typically going to find. Inside of a group plan, you're typically only covered for a percentage of your salary. Okay, and that percentage of your salary could be 50% of your salary, it could be 60% of your salary, and there's typically a cap. So it might be 60% of your salary up to $10,000 a month. The other consideration is that on group disability, if the practice pays for the benefit, it's taxable income to you. The third consideration is if you go on the group disability plan, you're no longer getting a paycheck from the organization, so you can't contribute into retirement plans, right? So it limits your ability to save tax efficiently. And then I think the most important thing is that inside of group plans, the language is not specific to a medical provider. It's specific to an entire group. And so I would definitely say that having a group policy is a nice to have, but I would really want to reinforce my income protection with a standalone supplemental policy that covers everything above the base salary, all my income from my procedures, from all my other sources, from my 1099s. So that's some considerations from taking into consideration what's available inside of a group benefit package.
Yeah, great information. Thank you, Jose. Well, I think we're back to Benny with a question here. And Benny, that question has to do with, you know, alternative investments. We hear a lot about alternative investments, and you know, we're not quite sure what they are, and do they really play a role in the overall portfolio?
The answer is yes and yes and no and no and yes. I can make all kinds of cases for you for alternative investments. They definitely play a role in one's portfolio, but you got to understand which portfolio it is, and you have to understand what alternative investment is before you get yourself involved. I mean, alternative investment could be as simple as just gold, or even real estate, or you know, commodities, managed futures. But also it could be private equity or hedge funds and, much more sophisticated items. These are most of the alternative investments, the typical traditionals you hear, are very expensive. David probably knows some ETFs that you can invest, which is less expensive, but even those are very expensive. The big advantage to an alternative investment, and the main reason why folks use it, is that it has low to negative, not negative, but it has low correlation to all the other assets that you invest in, right? So, for example, if you invest in gold as an alternative investment, the odds are that it's going to move at a different time that your stock portfolio moves. So if the stock goes up, mainly because of inflation, gold may come down, or vice versa. So what that does is, if you put asset classes that have low correlation with each other, you simply lower the volatility of your total portfolio. If all of your asset classes go up at the same time and all of your asset classes go down at the same time, then your volatility is going to be very high. So alternative investments just simply brings that low correlation. But first of all, you got to understand them. There's a lot of crazy. Bitcoin is probably considered as an alternative investment. Again, private equity, hedge fund, managed futures, these are all considered alternatives. Understand them. If you understand them and do your research, by all means, there is room for alternative investment in everybody's portfolio. And these days, because of introductions of ETFs and index funds and so forth, you can actually have alternative investment in this very small portfolios. It used to be that you needed millions and millions of dollars in order to have a hedge fund in your portfolio or a private equity. But these days you can actually introduce it. So to answer, the long answer to your short question is that do your research, study it, learn, don't get in it and by the way, previous results are no indications of future performance, right? So right now, alternative investments, private equity, if you can find any cheap investments, by all means, what makes you think that, private equity manager can find it? So you got to be very careful when you get involved in it and pay attention to the valuations and, again, understand it, learn it. I've spent years and years and years to try to understand it and get designations on it. It's not very simple. So, but yes, there is room in the portfolio.
Dave, if I could jump in on that briefly, I have a chartered alternative analyst designation, and we don't put any alternatives in client portfolios. So that's where I am on it.
All right.
Yeah, but to
well,
counter
thank you.
that, I can tell you that there are a lot of main, very big endowments in the country, multi-billion-dollar ones, that's all they have money in. 100% of their money is in alternatives. So
for a decade.
Right. There is no, again, there is no hard answer of yes, no alternative, or yes, absolute, a lot of alternatives. I think it depends on the situation.
Well, thank you, and we're coming toward the end of our time. So I want to let's see if we can do this with 1 minute for each panelist. What is and I want one aspect. All right. What would be the most important the most important criteria a client might consider for choosing a financial advisor? Hooman, you're on.
Yeah, I mean, in my opinion, choosing a financial advisor, well, first, they have to be, they have to have a good reputation, right? So you can obviously look them up on the FINRA website, for example, right, to make sure they have a good standing, right? But to my opinion of choosing an advisor that actually is going to coordinate with your other advisors, right? Your other attorneys, your accountants, your other financial professionals, because at the end of the day, what I believe in is that, without having that team, we're not going to achieve a lot of success, right? Yes, you can hit home runs, in the investment market, right? And you can have great insurance and you can have a lot of different things going on, right? But the key for me is to have an advisor who's going to be that center quarterback to be able to coordinate with your other advisors to make sure that your plan is staying current.
Well, thank you. Thank you. Great information, Hooman. Jose, how would you like to add to that?
Yeah, I would say that, financial planning is not about return on investment. It's not about numbers, it's about behavioral coaching. And I think a very important part of choosing an advisor is, do you align with them philosophically, and do you guys share the same values? Because what that means is that when you're working, whether it's 10, 20, 30 years with this advisor, are they moving you to change? Are they moving you to action? Or do you have a relationship where you're in alignment with values, and does that alignment help you make the decisions you need to make that are important for future you?
Great. Well, thank you, Jose. And David, what point would you like to add to what's been said?
Well, at the risk of sort of annoying all the other panelists, and I sort of apologize in advance, and I want to say this very carefully. So let me say the thing, and then I'll sort of explain what I mean. If you need a criteria to try to find somebody that is more likely, you're trying to improve your odds of getting a good advisor, I think the first metric is actually fee only. Now, I'm not saying that people who take commissions are evil or substandard advisors, but I'm saying your odds are improved probably. The population of fee only advisors is less conflicted than the population of people taking commissions. So I'm happy to exempt all the people on this call from that criteria, but in general, that's what I think is most important, is a fee-only advisor who doesn't have conflicts of interest to sell what may be inappropriate or expensive products.
All right. Well, thank you, David. And Benny, you have the last thoughts on this question.
Well, yeah, I mean, as much as I like to tell you, just Google my name and that's it. Oh, that's all you need to do. But no, I mean, what I would do, let me tell you what I do for everything else that I do in my life personally. I ask my friends and family. I mean, I talk to people that I trust. I say, who are you doing business with? What have they done for you? And how long have you been with them? And learn from them. Don't just pick up the phone and call someone you have never met and go to them. So, and then also the other thing I highly recommend, Dr. Walsh, is that remember, if you're married, there's two of you. Don't find someone that you like. Make sure that your spouse like him too, because the odds are, first of all, their spouse is going to end up with them anyway, because you're going to go first, because I see only guys on this call. So the odds are we're all going to die before our wives. So they're the ones going to be left with the financial advisor. So trust their judgment, and finally trust your own instincts and gut. Don't go with performance. Don't go. It's not just performance. It's not just fees. It's not just looks. It's not just great offices. It's all of the above. This is the most important decision you're about to make in your life. Don't rush it. Take your time, study it, and hopefully you'll be good at it. In the meanwhile, keep an eye on it. And if it's not working out, by all means, be on top of it. Don't let it get out of the hands, okay? But on top of that, just Google Benny Varzi and you're done. You don't need to do anything else.
All right. Well, gentlemen, we're at the end of our webinar. It's been very interesting. I want to thank each panelist for sharing your knowledge and experience with us this evening. And I know I've learned a lot. So with that, I'll hand it over to David for any closing information, and Randy for any closing information we might need.
Steve, thank you very much, and thank you to our panelists. I'm reminded of a joke about the doctor who went to meet a financial advisor, and the financial advisor took him on his yacht and showed him all around the yacht and said, do you have any questions? And the doctor says, yeah, where are your clients' yachts? Thanks again. Great presentation. Hooman, Jose, David, Benny, thank you for being on our panel tonight. I can tell just from the information that was presented and from the questions, there's going to be a tremendous amount of interest in continuing this series. Our program chair, Ali Rahimi, when he came up with this concept, thought this would be a great thing to continue on periodically, especially addressing physicians' needs at different stages of their careers, as obviously we could have several presentations for several different audiences. You can find this presentation recording on our MAA YouTube page, and the web address is there on the screen. And in closing, again, a special thanks to our MAA administrative team, David Waldrop, our executive director, and Shannon Andrada, our communications director. Thank you again.
Thank you.
Thank you, and good night all.
Take care. Good night.
Good night. Thank you again.
Mhm.